I get the opportunity to make an introduction of our key first lady of the event today. Kelly Fasterling is the founder of this event today. She's founder of the Wealth Summit, done a great job. This is our sixth Wealth Summit, Kelly. Kelly is originally from Pleasant Grove, Utah. She's a wife, mother of 4 kids, and she's a realtor, a real estate investor, and also a financial advisor. She's closed over 90 real estate deals in the last 10 years, mostly investment deals and so forth, doing very well in that case. But today she refers out all of the real estate business to members of her team, because she focuses all of her time on helping other realtors become successful and help them develop some financial freedom and so forth. Kelly is a very good financial advisor. She's an advisor for quite a few people in this room. And I highly recommend having a conference with her sometime. Just let her tell you what she knows. It's a lot. She's a smart lady. So, Kelly Fasterling. Today's her birthday. Okay.
Thank you all. Thank you all for coming. It is nice to see a full room and nice to have double that on the Zoom. So I really appreciate you guys taking your time, because it's a lot of time today. I'm going to take my topic today, my time, and we're going to talk about leverage. First, though, let me tell you a bit about why I'm standing here in front of you. Tell you a bit about my story. Okay. I did what a lot of us were taught: go to school, get a good job, you're going to be just fine, right? How many of you followed that go to school, get a good job path? Okay, a few less in this room because we're entrepreneurs. But I did that for 25 years. I was in software development. Loved it, got laid off a few times, but it was a neat career. In that career, you have such a myopic focus on your finances. That focus is this 401k that you get, and you get 6 funds to choose from. Have at it. I chose. In 2001, I lost half of that. Half. In 2008, I lost half of it again. Anyone share this success with me? Losing half their resources in a year. Okay. 2006, though, was a little bit of a different year for me. In 2006, that high-tech job, that was my second layoff, because companies go out of business. So that was my second layoff. At the same time, my husband left. He left me with 3 teenage boys, 11, 13, and 15, of whom I had 100% financial responsibility for. No job, 3 children, and diagnosed with a melanoma. So I'm sitting there in 2006 saying, I'm not liking this year very much. Something needs to change. I had to go figure out first how to put food on the table, because these guys eat a lot, a lot. How to put food on the table, how to sustain, and then how to recover. Because I had a 401k that was not in great shape, and I had a lot of work to do. So I started to shift. I started to get educated. My first education was Robert Kiyosaki, Rich Dad, Poor Dad, who's had the pleasure of reading this book. A lot of us in this room. That was my start into real estate investing. I got it. I heard his message. It resonated with me. And I decided that was the way I needed to go. Pay $26,000 like Kelly. Yeah, what do you invest in? Pay $26,000 for his education, for his mentoring. Got my first house. It was a lot of work. And I couldn't find my second. Couldn't find my second because this was back in 2012, when every time you'd put a bid in on a house, you had 20 bids behind it, and it made no sense to buy as an investor. So I had to shift and juggle. So today we're going to talk a little bit about leverage, but that setback for me back in 2006 put me on a trajectory that really helped me blossom and grow. It helped me move into real estate, in which I got my real estate license. And I have done some transactions, but I am not Kelly by any means. I'm not doing 40 transactions a year. But it put me on a trajectory of hopping into investing, doing a whole lot of referrals, but then understanding better how to manage money and how to take what we have and make more out of it. So back to Kiyosaki. How many of you have read his next book, The Cash Flow Quadrant? About five of us. Okay. That is an amazing book too. Let me kind of share the highlights of what he's talking about here. He has the left side of the quadrant and the right. The left side of the quadrant, that's where all the people are. 95% of us sit on the left side of the quadrant. How much of the money do you think is over there? It's 5% of the wealth, right, Hunter? 5% of the wealth is over on that left side because they're employees. They work for somebody. They're trading time for money. There's no leverage in that. There's no benefit. How many ever hours they work, that's how they get paid. And maybe they get paid a little more depending on their job, but that's how they get paid. Now, that lower left quadrant, that's self-employed. That's really where the bulk of us sit, right? Self-employed. We own a job, but we are still trading time for money. So Kelly's doing 40 transactions in a year. I can tell you she's hustling time for money in that. There's no leverage in that. It's how many listings you can put on, how many buyers you can show around. Okay. So what he talks about in this book is get yourself shifted to the right side of the quadrant. So how do you do that? Number one, up in the top right, you become a business owner. Now, how many of you in your real estate business think you're a business owner? I certainly did when I first got in. I'm a business owner. I own this business. It's up to me. I'm going to do this. Okay. His definition of a business owner is you can step away from that business. You can disappear for a full year. And that business is thriving. It is doing better without you. When you step away for a year and you just disappear. Now, how many of us are business owners? Exactly. Exactly. When that finally hits you, that you have no leverage, it is up to you. You realize that you don't have a business. You don't have a system that creates your income. For me, it's about passive income. What can create income so you can step away and not have to work as hard as Kelly is working. So, and then in the bottom right, he talks about being an investor and creating leverage on your investments. Okay. How do you take your money and make it do more for you? So in this session, I'm focusing in the lower right quadrant. Over lunch, I'm going to focus on the top right quadrant. Okay. How to create leverage. And we're going to talk about the 5 different things that can help you to create leverage in your life. One is time, the benefit and the value of time. A second is rate of return. And we don't often put it in perspective what the rate of return is truly going to do for us and give us. And I evaluate people's portfolios on a daily basis. I help people retire on a daily basis and look at where they're at and where they're headed. And as I look at it and they say, well, but that's doing pretty good. Yeah, but when you start looking at what that return can or can't do for you, it's eye-opening. So I'm going to show you that a little bit. The power of zero. Have any of you heard of the power of zero? Is that a concept you've heard of? A couple nodding your heads. Okay. We're going to talk a little bit about the power of zero and how that can create leverage in your assets. The power of and. Is that a concept anyone's come across? Okay, no one. So that we're going to go over that and how you can create some multiplication. And then everyone's heard of other people's money. We do it in real estate all the time. We use the bank's money to help people buy houses. So in real estate, we've kind of got this one down a little bit, using other people's money. So let's go in. I'm going to combine and put together time and return because they kind of go hand in hand. Okay. Compound interest is the benefit, the value of both time and return over time. So Albert Einstein, notably one of the brightest fellows that we've come across in the last century, said compound interest is the 8th wonder of the world. He who understands it earns it, and he who doesn't pays it. So when you really get your arms around the concept of compound interest, you'll understand it. So let's kind of look at a chart. Let's kind of just look at numbers. So back here, we're looking at ground zero, $10,000. If you had $10,000 to invest this year, okay? And we're talking about investing that at a 6% return. And we're going to take that $10,000. That's just it, just a flat $10,000 for the year. And we're going to let that $10,000 just grow at 6% for 10 years, for 20 years, for 30 years. You can see what time did to magnify that $10,000. Now I have 3 boys and I talk to them constantly about start early, start now. Don't wait and don't think you're going to get to my age and then hope you're going to recover your retirement, because that time will not be on your side at that point. It'll be difficult to allow it to give it the time to build. So that $10,000 investment became $57,000 over a 30-year period at 6% interest. Okay, that's a lot of growth. If you waited until you were 55 or 60 to place that $10,000 in the bucket, you're not going to see that kind of growth. So let time work for you. And you guys that are still young, start, just whatever you can, just start. Take a percentage of every check you get and set it aside and just invest it. Next, let's couple time with the rate of return. And I just want to show you some numbers so that it will start to sink in terms of what that rate of return can do for you. Now, this lower line here, who can see the flat line there? Okay, the flat line, that's the bank. That's bank interest. Now, I work with a lot of realtors on their financial planning. And I tell you, all of us that are in a commission-based business put a lot of money in the bank, right? That becomes our go-to place. And the reason it is, I mean, I have realtors that have 100,000, 200,000, 500,000 sitting in a bank, flatlining like that. Now, you know, and then there are others that have 5,000 or 10,000. So whatever your level is, doesn't matter. The fact that they have such a large percentage of their asset base flatlining for them is not an investment strategy. Now, we all have things to take care of, and we are all in a situation where we may not know when that next commission is coming in. And if we don't know when it's coming in, we've got to take care of ourselves, right? So we've got to have that liquidity so that we have the float to make it through October, November, December, right? But we want to be sure to look at the opportunities and where else it could go, because there are other options for that liquid money that you need to touch. So if we go now to the second line here, that's that line we were just looking at on the last page. That's your $57,000 6% line. So 30 years, 6%, $57,000. Now this is the part that most people don't see. The next number here is 8%. So that third line is 8%. You can see the growth over a 30-year period at 8%. It's just 2 points above the 6%. It's almost double the money. It's about 100,000 after 30 years. So that compounding with that just 2 extra points makes a massive difference. Now let's go to the last line here. This one that comes way up here, it's 300,000 up here. That's the same $10,000 investment, earning 12% for 30 years. So now if you have the choice of earning 6% or earning 12% for a 30-year period of time, would you settle for 57,000 or 300,000? That's the difference. So you really do have to take a look at what it's earning you. And then you've got to look at the amount of cash that you keep in the bank and look for alternatives to bank assets. Let's go to the next concept, the power of zero. In this concept, you kind of see the green and the black. Let's do the black first. This is the market between 2000 and 2013. It was up, and then it was down just as steeply. And then it was up, and then it was down. That is called the lost decade, 2000 to 2013. If you started with $100,000, by 2013, you had $100,000. Now, these were some of my earlier years in investing, and I'll tell you, those were some tough years because you're thinking that you're starting to do the other lines that we were looking at on the last page, and you're not. Your portfolio is not growing at all. I was just listening to a podcast this morning, and there are some pundits that are saying we're headed into that next 10-year window. I don't know. I don't know. But you're hearing some talk about that. So how do you then leverage the power of zero so you don't have another 2000 to 2013, another lost decade? So if we take this and we start with investing just $1,000, and if you go take $1,000 and you earn 10% on it, it's a good year. You earn 10%, your 1,000 went up to 1,100. Now, if the market drops and you lose 10%, where are you sitting? You're sitting at 990, right? You're down below your 1,000. Now let's do that in another cycle. It goes up again and it drops another 10%. You're down even farther. By the time you go through 5 cycles, you're sitting here at 950. You went backwards if it just goes up and down the same amount. Okay. Now, if we instead earn 10%, and then we're in an asset class that prevents losses, where we don't go backwards at all. Now, if the market tanks, you just don't get anything. You get zero, but you don't go backwards. So now you flatline for a year. And then when it starts to pop back up, you start to go up again. You get another 10%. And then you flatline for another year. But I can tell you, flatlining is a whole lot better than taking the fall backwards. At the end of the day, that $1,000 grew to 1,610. So it puts you in a whole different position on a $1,000 investment to get it protected. The next concept, the power of and I know I'm rolling through these. We can sit down offline. We can talk about these if you want to know more. The power of and. This was, for me, one of the most pivotal concepts that I learned. And Steve, I'm gonna have you stand up because I'm gonna introduce you. Steve Carruthers has been absolutely powerful in my life. He did what Kelly did, is he just talked to me. I met him when I was looking for my second house. You can sit up. I met him when I was looking for my second house back in 2012, and I couldn't find it. I was at a happy hour. We were chatting, and he was looking for a credit partner, and so we got together. I understood what he did, and he introduced me to a concept called Done For You Real Estate. I started investing in that program, and that's kind of where I've created a whole bunch of transactions. Then he came to me and he just a casual comment. Kelly, Michael's teaching this class up in Keystone. You need to go. Well, Steve, what's the class? It's about managing your money. You need to go. I mean, it was that you need to go. Okay, I trust you. I'll go. So I went, and that was the power of and. I learned all about that. Now, Steve's third introduction to me was, Kelly, you need to come and look at EXP. Steve, okay, just come to lunch. I did. Anyway, so the power of it. Let me share this idea with you. Okay, when we invest, we typically think of the different asset classes we can invest in. We can invest in the stock market. We can invest in the bank. We can invest in a CD. Right now, actually, they're pretty good. We can invest in a life insurance-based product. There are a lot of places in real estate. A lot of places we can put our money. The power of and is a different concept. So let's just say you were kind of choosing where you wanted to invest, the stock market or maybe a life insurance-based product. Okay. And maybe either one of them earns 9%. You pick or choose which one you like. Okay. If you take that $100,000, you just have $100,000 to invest, and you let it roll for 20 years, you're going to end up at 9% interest with about $600,000. You can be pretty happy with that. That's an okay return. Okay. Now, if you're a savvy real estate investor, I know a bunch of you in this room are, where you've done some houses yourself, you can spot a good deal. You can bring that home and you invest in, maybe you're getting a 17% return, because in real estate, you get the cash flow, the appreciation, you get some depreciation, maybe some cost segregation. There's some bennies that you get, especially as a realtor, and maybe you're getting 17% return. And if you had to choose between the 17 or the 9, now that 17% return, we're just doing math. Just take 100,000, compound it out for 17 years. It's 2.4 million. Which one of these two are you going to do? Are you going to do the index universal life or the stock market, or are you going to do real estate? How many hands in this room are going to go opt for the real estate? Yeah, exactly. Exactly. So that's or, either or. Which one are you going to do? Let's talk a little bit about and. How do we couple both of them? So now I have to take the stock market out because you can't put it in the stock market and take it out and go invest in real estate. But you can do that in a life insurance-based product. You can put your money in a life insurance-based product, pick the right one, design it right, fund it right, use it right, a lot of caveats, but you can use a life insurance-based product and you can put the money in. And then when you're ready to buy your next house, or maybe you're a crypto investor, or maybe you've got, great deals on futures. I don't know. But when you're ready to take it and do something else with it, you loan it to yourself. So you're still earning 9%. So you put the money in, it's still earning 9%. You loan it to yourself. You've got to pay for the loan. So you pay 5% for the loan. A lot of these products cap 5%, even with the interest rates going as high as they are. They're capped at 5%. So you're making 9% on money that's not there because you bought a house. You're paying 5% for the benefit. So you're really getting a positive 4%, what we say, a positive 4% arbitrage. You're making 4% on money that's sitting over in your real estate. So now you add, it's in real estate making 17, and you add the 4% to it. How much are you really making? You make 21%. At 21%, how does that compound out? To 4.8 million. Those couple of points different in the rate of return really multiply over time. It's some stunning numbers. But if you just run the math on it, I'm just talking $100,000 day one, 20 years later, that's what you're sitting with. Okay? So that's the power of and. That's how you take $1 and you use it 2 different times. Now let's go one step farther into the power of leverage. Okay, let's make it simple. Let's say you own an apple orchard. Okay, you're down in Southwest Colorado owning an apple orchard. You got a contract with Walmart, and you can sell a box of apples to Walmart for $11. It's a good contract. But just like trading time for money, how many boxes can you create? It's however large your apple orchard is, right? And then you're done. Your apple orchard's done. You've sold all your boxes. Okay. You got a neighbor. He does not have a contract with Walmart. He can't get a contract with Walmart. And he's more than willing to sell you his box for $5. So you can turn around and sell it to Walmart for $11. How many of those neighbors are you going to talk to, buy their box for $5 and turn around and resell it for $11? You might talk to a few different neighbors, and you might use leverage to take that and create some return for the 2 of you. Okay, you can do the same thing with $1. So this is kind of a coupling now what we just talked about with the power of and with the power of leverage. So you take $1, and if you can make 11% on that dollar, but you can borrow money at 5% to make 11%, how many dollars are you going to borrow to do that? What kind of swap are you going to do on that? Okay, so once you get some of these concepts down, it's really easy to see how folks that have just a little bit and they start down the right path can really take all of that and make it multiply. It's with a number of these concepts. So the power of time, really letting time work for you, giving it the best shot. The power of return. I offer a review of where your portfolio is sitting. And so if you want to look at what asset you're in, what kind of risk profile it has, that power of 0, if you want to look at what kind of return it's getting on average over the whatever time it's been out there in that investment, I have a report that I can run and it just flat out shows you. And occasionally I'll have a client that wherever they are, they're doing great. And I'll just tell them, don't move it. That's awesome. Just stay there. And more often than not, it's they didn't realize they were really only getting a 4% return and that they lost 50% back in the day. So to really look at that and just have the information gives you that. The power of and the ability to start multiplying and using $1 multiple times and then using other people's money. So If you want to know how much leverage is in your portfolio, then just, take a picture of the QR code. We'll bring it up again at the end. And let's just sit down and talk and review it.